Picture this. You're finally doing the responsible thing, right? You start saving money every month. You move $100 here, $200 there into your savings account. You feel financially mature, disciplined, secure. But then you start hearing your friends, or maybe people on the news, talking about investing. They're throwing around terms like stocks, index funds, compound growth, and suddenly that feeling of financial maturity is kind of replaced by this nagging question. You look at your savings and think, wait, am I doing this wrong? Look, if you've ever felt that exact frustration of doing the quote-unquote responsible thing by saving, only to wonder if you're somehow totally missing out on building real wealth, you are absolutely in the right place. Because, well, here's the painful reality for so many diligent savers out there. Let's say you do an amazing job and you actually manage to get $10,000 sitting in a typical savings account. If that account is earning something like 0.5% or even 1% interest, after an entire year of leaving that money totally untouched, you've made a tiny $50 to $100. That's it. Meanwhile, inflation, which averages around 3% a year, is just quietly eating away at your money's purchasing power in the background. Your 10 grand will literally buy fewer goods and services next year than it does today. So saving alone, it's just mathematically insufficient for actually building wealth. Welcome to This Explainer. Today, we're going to build a safe, structured bridge taking you from anxious saving to confident investing. We are going to look at the exact step-by-step path to turn your savings into investments. So, here is our roadmap. First, the trap of saving. Then, saving versus investing. Third, the step-by-step path. Fourth, the magic of compounding. And finally, avoiding common mistakes. All right, let's jump straight into part one, the trap of saving, and why saving alone just isn't enough. Let me validate your current behavior for a second. Saving money is a crucial first step. It is incredibly important because it creates your baseline of financial security. But think of saving money like storing seeds in a glass jar. You're protecting those seeds, right? No birds can eat them, the rain can't wash them away, they are totally safe. But inside that jar, absolutely nothing grows. Wealthy individuals know that they can't just stop at the jar. To actually get a harvest, they have to take those seeds and plant them in the soil. And that is exactly what investing is. Savings protect your money. Investments grow your money. Which brings us perfectly to part two, saving versus investing, protection versus growth. You see, there are two totally distinct jobs for your money. First, you have your safety money. That's your savings. The purpose here is strictly protecting your capital. The risk is very low, returns are a super meager 0 to 3%, and you need it to be accessible short-term for emergencies. On the flip side of that coin is your growth money. That's investing. The purpose here is to actually multiply your capital. Now, while the risk moves up to moderate and it's very much a long-term play, historically, diversified stock markets return between 7 and 10% annually. So, saving is short-term protection, investing is long-term growth, and you absolutely need both. Let's let the math do the heavy lifting for a second here to really put this into perspective. If you put $10,000 in savings at 1%, after 20 long years, you only have about $12,200. But if you invested that same $10,000 at a historical average of 10%, you would have roughly $67,000. It's the exact same starting money, but a completely different outcome. The biggest wealth gap out there isn't actually between people who save and people who spend. It's between people who save and people who invest. Okay, part three, the step-by-step path. Let's look at bridging that gap safely. The reason most people don't cross that wealth gap isn't because of the math. It's psychology. Investing feels risky. So we have to bridge that gap safely. Step one is your foundation. Earn and save money. But step two is where we build the real armor. You need to build a 3 to 6 month emergency fund, stored entirely in cash, strictly for unexpected problems, like a job loss or a major car repair. Think of this like the solid concrete foundation of a house. If you don't have this, one random life panic is going to force you to sell your investments at the worst possible time. Then, step three, which is so crucial, mentally separate your safety money from your growth money. Safety money doesn't move, growth money is allowed to fluctuate. Establishing this mental wall reduces your anxiety dramatically. Building on that foundation, Step 4 is to just start small. You do not need thousands of dollars to start investing. Literally start with 50 or $100. The goal right now isn't massive profits. The goal is just building the habit. Step 5 is to automate your investments. This is a brilliant strategy called dollar cost averaging. By automatically investing a set amount, say 10% of your salary, every single month, you completely remove human emotion from the equation. You aren't trying to guess or predict the market, you're just consistently investing over time. And finally, step 6, focus on simple, boring investments. Don't jump into complicated day trading or crypto speculation. Honestly, the most powerful investing strategy is actually pretty boring. So you're probably wondering, what does a boring, simple investment actually look like? Well, enter the index fund. This is pretty much the perfect tool for beginners. Instead of stressing yourself out trying to research and pick one individual winning company, an index fund just tracks the overall stock market. You are effectively investing in hundreds of companies all at once. Rule of thumb: if you don't understand how an asset generates value or what its risks are, you shouldn't put your money in it. But index funds are brilliantly simple to understand. They offer instant diversification, lower risk, and really steady long-term growth. In fact, the legendary investor Warren Buffett famously said, "Never put all your eggs in one basket." He repeatedly recommends low-cost index funds for most everyday investors. Think about it. If you put 100% of your money in one single company and that company fails, you lose. But if you spread your money across hundreds of companies and one performs badly, all the others are there to cushion the blow and reduce the damage. Diversification doesn't entirely eliminate risk, but it significantly reduces unnecessary risk. All right, moving on to part 4, the magic of compounding and why time is your greatest asset. The truly mind-blowing reality of investing reveals itself over decades. Let's look at Sarah's 40-year journey. She invested just $300 a month. Assuming an 8% average return, she only contributed $144,000 out of her own pocket over those 40 years. But because of compound growth, her estimated portfolio value is over $1 million. Compounding is simply your money earning returns on your previous returns. It creates this massive snowball effect where small gains become large gains and large gains become significant, life-changing wealth. Time, not a massive starting salary, is absolutely the investor's greatest asset. Finally, part 5, avoiding common mistakes and protecting your journey. As we wrap up here, we need to quickly look at the specific pitfalls that trip up new investors, just so you know exactly what to avoid when things get rocky. First, do not invest without an emergency fund. We already covered why that foundation is so critical. Second, avoid trying to get rich quick or blindly following social media hype. But honestly, the most dangerous mistake you can make is panic selling during a market decline. Market crashes are completely normal. They've happened dozens of times throughout history. Long-term investors actually use downturns to their advantage. When the market drops, your automated monthly investments are suddenly buying more shares at lower prices. It's literally like your favorite store having a massive clearance sale. Experienced investors stay calm because they're thinking in decades, not days. Constantly changing your strategy or panic selling, that really just locks in your losses. Let's bring this all together. The transition from saving to investing is fundamentally a journey from protecting your capital to creating long-term value. Yes, you need both, for sure, but you absolutely must understand their distinct roles in your life. Saving money gives you stability, but investing money, that gives you freedom. The people who achieve real financial freedom aren't necessarily the ones who earn the highest salaries. They're the ones who systematically transform their savings into productive investments and then simply give those investments enough time to compound and grow. So I want to leave you with this final provocative thought to reflect on today. Take a hard look at your own financial habits. Are you currently stuck in the saving stage, proudly looking at your jar of protected seeds? Or have you built your emergency foundation and transitioned into the investing stage where those seeds are finally planted and growing? If you haven't started yet, remember, you don't need thousands of dollars. You literally just need a solid foundation, a little bit of consistency, and the willingness to take that very first step toward your financial freedom.